Is it possible for a government-owned company to deliver massive dividends and more than 200% capital appreciation? Most investors believe PSU stocks are boring. Today, we are deep diving into one such company that has completely changed this perception. This is REC Limited. It is a Government of India enterprise under the Ministry of Power. Its primary business is financing power generation, power transmission, and renewable energy projects across India. REC works closely with Power Grid, NTPC, and state electricity distribution companies. Because of this, business visibility is strong and cash flows are predictable. For many years, investors believed REC only lends to state electricity boards. That perception is no longer accurate. REC has transformed itself into an infrastructure financing institution and continues to dominate financing in the power sector. This includes lending to distribution networks and transmission infrastructure. As you know, power remains the backbone of India's economic growth. REC operates at the core of this system. India has set an ambitious target of 500 gigawatts of renewable energy capacity. REC is now a lead financer in this transition. Its exposure includes solar energy, wind power, and green hydrogen projects. So REC is not just funding projects, it is financing India's future energy framework. Expansion beyond power. REC has expanded beyond power financing. The company now lends to metro rail projects, roads and highways, ports, and data centers. REC is no longer only a power company. It has become a nation-building infrastructure financier. A company once considered boring has become strategically important to India's development story. The key question remains: can REC continue delivering high dividends and sustainable capital appreciation? That is what investors must evaluate carefully.
Rural Electrification Corporation, as a large, government-backed institution with a focused mandate, its net interest margin is generally stable, but not as high as some private sector lenders. It operates with a significant cost of funds advantage due to its high credit rating. REC Limited has reported a strong and improving net interest margin, 3.64% in the financial year 2025, and management expects to maintain net interest margin in the range of 3.5% to 3.75% going forward. This is generally in line with or slightly better than other large NBFCs focused on infrastructure, but lower than retail-focused NBFCs or banks with low-cost current and savings accounts. REC consistently delivers an ROE above 20%. This indicates highly efficient use of shareholders' capital to generate profits. Its return on equity has shown a remarkable and sustained upward trajectory over the last 3 to 4 years, transforming from a subdued level to one of the highest in the Indian financial sector. This has been a primary reason for its strong re-rating in the stock market. Now, considering rural electrification's return on assets has fluctuated slightly, averaging around 2.5 to 2.6% for the fiscal years 2021 to 2024, hitting a low of 2.2% in the financial year 21 and peaking at 2.8% in the financial year 24, with recent data showing it around 2.56% for the financial year 25, indicating stable but moderate asset utilization for profit generation over the past 5 years. This is considered healthy for a large-scale financer. It shows that for every 100 rupees of assets, the company earns nearly 2.80 rupees in net profit. Up next, net profit margin, 28.1% in the financial year 25. These figures indicate strong and stable profitability for the company, generally hovering around the 20% mark. Although down slightly from 29.8% in financial year 24 due to higher operating expenses and tax adjustments, a 28% margin remains exceptionally strong, reflecting robust financial performance. Now let's talk valuation, and this is where REC Limited really stands out. At a PE ratio of just 5.8, the stock is trading at a deep discount compared to both the sector average and its own historical valuation. This suggests the market is still underpricing REC's earnings strength. Add to that a dividend yield of around 5%, which means investors are getting strong cash returns every year, significantly reducing downside risk and improving overall return potential. Most importantly, the PEG ratio of 0.57 clearly indicates that REC is undervalued relative to its growth prospects. In simple terms, you're paying less for each unit of growth. Low valuation, high dividend income, and solid growth visibility, this combination makes REC Limited a compelling value opportunity in the current market. Based on our discounted cash flow model, the intrinsic value of REC Limited comes in at the range of 380 to 410 rupees, assuming conservative growth and margin assumptions. Using the dividend discount model, REC Limited's intrinsic value comes to around 540 rupees per share, supported by its strong dividend visibility and high payout sustainability. On a relative valuation basis, if we benchmark REC Limited against its peers at a conservative 8 times PE multiple, the implied fair value works out to around 480 rupees per share. Taking a conservative approach, factoring in typical PSU risks, but also recognizing REC's superior ROE and improving asset quality and growth visibility, a reasonable fair value estimate for 2026 lies in the range of 480 to 520 rupees. In summary, at a current price of 380 rupees, REC Limited is trading at a 25 to 40% discount to its fair valuation. A conservative, fair value for 2026, considering PSU risks but recognizing its superior ROE and growth, is 480 to 520 rupees.
Now, let's analyze REC Limited from a technical perspective. Starting with the weekly chart, we have identified a complex corrective cycle in REC Limited. The stock completed a WXYXZ complex correction around 331 level, which also suggests that Wave 2 has likely ended at this zone. Since then, the stock has started to rebound. Importantly, REC has rebounded from the midpoint of the 50 to 61% Fibonacci retracement zone, a technically significant area. At the same time, on the daily chart, the price has moved back above the 20-day and 50-day EMAs, indicating a short-term trend reversal. For REC Limited, the 330 to 360 range now acts as a strong demand zone, and the stock is currently trading at a favorable price level for potential entries. Next, we drew a descending trend line, which the stock successfully broke out at around 358. A breakout retest in this zone is possible, but for now, 360 is acting as a strong support for REC Limited. From 360, gradual accumulation can be considered. From a broader view, REC is fundamentally very strong, and technically, the stock delivered a massive rally between June 2023 to July 2024, offering attractive trading opportunities along the way. According to Elliott Wave analysis, REC appears to be entering Wave 3. If the stock either retests and rebounds or finds support near the 20-day EMA, the third wave could begin, with a potential upside target in the range of 750 to 870 rupees. On the way up, the stock is expected to face two major resistance zones, the first around 480 to 500, the second between 580 to 630. Overall, REC Limited is positioned quite attractively from a technical standpoint. Dollar-cost averaging can be considered for entries. Given that the stock is fundamentally sound and suitable for long-term investment, we are not suggesting a strict stop-loss at this stage. Friends, this was our observation on REC Limited. If you find this analysis useful, do subscribe to the channel. See you in the next video.